Well, good afternoon, investors. Welcome to our August 9th, 2022 Bull Sessions. My name is Mark Robertson. I am joined here by Ken Kabula and our dear friend from Florida, Kim Butcher, by way of Evansville, Indiana. Good afternoon, guys.
Good
Hi,
afternoon,
everybody.
Mark. Hi, folks in the audience. Glad to have you with us.
Yeah, we've got a pretty full set of people, even though I got the notifications for the meeting up late and everything else. I've been running around like crazy trying to keep up. And yesterday we had a moment. We lost Olivia Newton-John. That's why she's on the cover slide. She's obviously a personal favorite from the days of Grease, and we all mourn her loss. Is Grease a movie that rhymes with either of you?
I love the movie Grease, Mark, and you know my background in musical theater, and we did Grease 4 different times over my 30 years. It's a real popular show with high school kids. Also, it seems to really resonate with them, even though the music is now 50 and 60 years old. It really seems to strike a chord with 15, 16, 17-year-olds, and they do a wonderful job on that show. It's a great show also because you can feature a dozen or 14 kids. They all get big roles and they all get a song, and makes all the parents happy, makes the kids really happy, and everything else.
How about you, Kim? Did you have a John Travolta poster on the wall of your house?
I never had any posters on my wall, but I did watch it many times.
All right, well, great. All right, we are going to talk a little bit about the reality that you can believe in magic. There are no guarantees in investing, but boy, you put the right patience and discipline together, and magic can happen. Ken and I actually talked about that this weekend with an audience that was actually nationwide, but it was a presentation for the Central Indiana chapter in Indianapolis. That's the graphic there. I'm backing up the truck. And Sir Winston joins us once again with some words about investing that I think you'll enjoy, as does Peter Lynch. And there's a nice Peter Lynch moment in here. And as a little bit of foreshadowing, that last picture on the bottom, that balloon, is actually the first piece of photographic wallpaper for a particular brand of software that we're going to be talking about today. How's that for a tease, Ken?
Well, that's a great tease. I just watched a movie that featured Mr. Churchill, and I would highly recommend it. A Netflix movie with Colin Firth called Mincemeat, about something in World War II that I really knew very, very little about. And that was the invasion, or I guess invasion's a great word, the invasion of Sicily, which preceded D-Day,
Right.
but which kind of softened up the German army for eventual defeat. It's a really very well done movie. And again, I said it features Colin Firth. If you have a chance, if you have a Netflix account, I would take a couple of hours and take a look at it. Really well done, and not a typical war movie. It's not full of blood and guts and glory and everything. A very cerebral kind of war movie, in fact.
Cool. All right, let's go ahead and get underway with the legal paperwork. No investment recommendation is intended. Unless you're new here, you already knew that. This is an educational demonstration. Everything that we do here is based on taking the stuff we've learned over 8 decades with the Modern Investment Club movement. That's down from the methods we use to discover and identify investing opportunities, the types of study, and the gauntlet that we put them all through as we try to determine if they are excellent companies. And then we take the next step of figuring out, okay, I've got an excellent company. Is it on sale? That's what we do here. We basically build portfolios using that same technique. We design them, and then we manage them using those key parameters to do that. So that's what we try to demonstrate at Manifest Investing and with our bull sessions and roundtables that we do. So you're going to hear our opinions. Please do your own homework when it comes to making any decision about anything that we talk about. If we hold shares personally, we will try to remember to tell you that. we do a monthly program called the Roundtable. We are going to talk about the Roundtable during this session. And it's just basically a monthly get-together to share 4 or 5 investing ideas. At last count, we were running at approximately a 16% internal rate of return since 2010. So some of the ideas have been pretty good. If you'd like to be added to an email reminder list when that session is held, again, it's usually on the last Tuesday of the month, 8:30 Eastern Time. It's always a webcast, except when we do it in person, face-to-face at one of the national conventions or other meetings. Send an email to nkavula1@comcast.net. By the same token, if you'd like copies of these slides or if you have follow-up questions or suggestions for future topics, our 2 email addresses are at the bottom there. Mark r@manifestinvesting.com and kkavula1@comcast.net. All right. Here's our market gauge. Again, the key point here is that we have had a pretty robust market for the last 5 weeks. The green bar, which is basically the prices of the stocks that comprise the value line arithmetic average. So you're looking at about 1,700 stocks. That green bar has tracked back to the blue line, which is the long-term trend. And in doing so, the prices have gone up, so the return forecasts have gone down. The current value line median appreciation projection, they call it VL map, is actually hovering right at about 13%. So keep on trucking, and we'll just continue to hope for the best. Any comments or questions on this at this point, Ken?
No, great slide. You know how much I like this slide. Mark, we did get a question about Neogen before the program started. And we're getting a lot of folks in our audience telling us things about Neogen. There is going to be a substantial merger of a division of 3M with Neogen, but that's not, the company's not going to disappear. The merger is going to take a subsidiary of 3M and merge it with Neogen, and it'll still be called Neogen. The subsidiary is about 35% the size of Neogen itself, so it will be absorbing a pretty large group of things. The reason that I didn't think that there was anything going on with Neogen, that back in the beginning of July, Neogen announced a pretty large number. I'm thinking 350 million, something in that neighborhood, where they're going to completely redo their campus in East Lansing, Michigan, and build a new headquarters and everything. And I didn't think that was the kind of move that a company that was considering going away or being acquired would take into, would publicize. So I'm reasonably certain Neogen's here to stay for at least a little bit of time.
Okay. Well, just to let you and Mark both know, I found the press release and I sent it to you both.
Okay.
Okay.
Exactly what's happening.
Yeah, and the 3M division, that's not new news. No, I mean
that's coming from February. Yeah.
I'm pretty sure we talked about it at a session.
Yeah.
Back around that time frame. Okay. All right. So here I've got a series of 4 slides that come from the Visual Capitalist, a really neat graphic display. Just thought we might spend a moment talking about this one. Sean Mesa really loves this one as a topic because he actually gets visibly irritated when people who like a stock get 80 and the quality and everything is just fine and it drops down to 60 and they say, what's wrong with it? And he says, you don't do that when you're out there looking for, furniture or appliances, and they sell you the floor model because it's got a tiny dent on the back where no one will ever see it. And they give you 30% off, and you do cartwheels and handstands. And that's kind of what's being talked about here. Buffett is basically saying, if you're talking about quality merchandise, when it gets marked down, it's not time to wring your hands. It's basically time to dial your broker or write a check. And this is a slide which basically shows that people who have maintained that passionate discipline. The other thing I like here, Kim, and you can chime in on this one, is that it basically is nibbling at the edge of one of your favorite indicators, the bullish spread.
Right.
Would you care to say just a few words about how you watch that?
Well, I look at BPI's, bullish percent indicators, and I look at that on stock charts, and I look at like the NASDAQ 100, the New York Stock Exchange, New York's 100, and I look on what's going on, and basically all it gives me an indication is who's buying. Are people buying or are they selling? It doesn't tell you, flat out what's going to happen in the market, but I saw an indicator, I want to say June the 17th, that 4 of the 6 indexes that I was looking at was down in the 10s. And kind of like anything else, when we have, if it's anything is below 30 means it's oversold, anything above 70 means it's overbought. So 10, when it was down to 10, I was like, okay, it's time to go bargain shopping.
Yeah, and here's a case of 16 back from April. That's what she's talking about here. And basically that's when everybody's terribly pessimistic. And the point being, who knows what this is going to hold, but in the past, a majority of situations had pretty favorable outcomes when you find the discipline to pursue excellent quality companies when everybody else seems to be running scared.
We have a good question out here, Mark. Where's the data coming from for the stuff you just circled?
This is all coming from, well, in this case, Bloomberg is cited on the slide. So they're basically using a bullish bear spread index from Bloomberg, and I suspect the rest of the information on the slide is also a Bloomberg source.
Do you know if this has any connection to the AAII survey that's done on a regular basis?
I don't know the answer to that.
Okay.
That's more of a sentiment survey, where this would be more of a what are they actually doing type measurement. It's a different kind of metric. They're probably related, but I do not have any feel for whether the American Association is any more worthy. And then as our reminder down at the bottom, Warren Buffett with a 54-year track record, and that's not a 14% return, it's a 14% relative return. So that puts him north of 20% per year over those 54 years. That's special in anybody's Hall of Fame. So worthy of listening to.
It makes you wonder if he's that well. What does he see in Occidental Petroleum?
It does.
He's got over 20% of it now.
Yeah. Careful, we'll have to towel off Len Douglas. Okay. Yeah. Next slide comes from Shelby Davis.
Mark, yeah. Len is telling us that off to the well, he doesn't say where on the slide, but he says there's a note right on the slide that does reference the AAII survey. Len, I'm not sure that I see that reference, but
it does reference it right here.
Where are you? Where are you marking, Mark? Oh well. Okay, I understand why I'm not seeing it. All right.
It's small, but it's there.
It's really small, yeah. All right. And on top of that, it's written in light blue, so that.
All right. Thanks, Len. Always keeping us honest. All right, our next investor, we'll start on the lower left, 45 years and still a plus 10% return. Those statistics come from the book Excess Returns that we've talked about following the work of the founder of AAII, James Clunan. So, now again, this is just a reminder that, boy, these things happen on a regular, I'd even almost call it routine basis. But the thing to always remember is that for all the hurt that bear markets bring to us, they actually bring opportunity, and they only account for about a third of the time of the actual overall market. So there's some pretty powerful words on there, and the one that other people have written back to me and said are really reassuring is right here, that no matter what is happening out there, it's ultimately surmountable until it's not, and if it's not, we won't be talking about investing.
You know, Mark, it might be time to pull out that 3-year S&P 500 results and 5-year S&P the histogram that shows the different time periods and shows how few of them are actually negative. Might be time to pull those graphics out again and just display them.
Doesn't one of your local investment clubs have that as a tapestry or something that we could just take a picture of?
No, we don't have a needlepoint done of that one yet, but
Well, tell Natalie to get one of her friends working on that.
Get working on it. Okay.
But I think that's a pretty powerful message. And then here's another one. This one comes from the king of asset allocation, Peter Bernstein, but he does have some interesting thoughts. Is again this notion of when things are really nasty, just take a step back and think long-term perspective is the way I read this. I also found it kind of interesting that Ken and I were preceded by a university professor from the University in Indianapolis on Saturday morning, and he covered quite a bit of this stuff, including spending a fair amount of time getting some comfort from the condition of the Purchasing Managers Index. So what I thought I would do is just show what that, I thought I put the slide in here, and I didn't. Oh, yes, I did. Here's the Chicago Purchasing Managers Index. Even though it's been trailing off, there have been signs that it's strengthening. Anything over 50 indicates an expansionary time frame. And if that actually bounces and doesn't continue to head south, you can see here's COVID, this one here, and then back in 2008, the last time it was pretty nasty. So Dr. Will actually spent quite a bit of time talking about that. Anything else come to mind here, Ken?
Well, I was intrigued by some of his takes on some of the data as well, especially intrigued by his take on the Inflation Reduction Act. He was extremely negative on it, and evidently is associated with a group of economists that's not getting the same kind of press as some of the other groups of economists are getting. Evidently, the Congress had been flooded with not only economists that were telling them that it would accomplish what they thought it would accomplish, but a lot of economists throughout the university systems were flooding Congress with evaluations that it would not do anything to deal with inflation. That's the new act that just passed the Senate and is poised to pass the House in the next week or so.
Yeah, he was quite negative on it, and it was interesting to hear some of the background thinking on it. Here's a slide that we have covered here fairly recently. Again, when we talk bear markets and recessions, we think in terms of what is the impact on the average stock as we do our studies. And as you all know, when earnings go negative, it basically makes a stock selection guide catatonic sometimes. And that happened back in 2008, 2009, and then in the early days of COVID. So that's what we kind of watch for. Are we in a recession or not? Dr. Will basically said, yes, we are. Mathematically, we are. We also have this situation here that basically says, even though we can find a bunch of companies that are attractive right now, there are equally a number of companies that are not and seem to be headed in the wrong direction. So, that's kind of a vote for, if not in a recession, certainly trending towards recessionary conditions.
And we should make a point too, Mark, that bar, that 2022 bar, is a work in progress. There's still 5 months left in that bar, 4.5 months left in that bar before it finally settles into to historic data.
Yep, and the 3 to the right of it are also bubbling away.
Yep.
As expectations drift around. The other thing that we've talked about from time to time, and this is just a quick reminder, is that any time that the number of stocks hitting new lows begins to exceed the numbers hitting new highs, you can see that it happened back in 2008. It actually started, the real bad stuff started happening on Halloween 2007. And it was the deepest, ugliest time in stock market history. We do have a moment in time that's looking a little similar here. And notice that you had several months before this actually, the trend of new highs and new lows actually went negative. That actually happened for us back towards the end of last year. And we hope to continue to see recovery. We might actually be at this point in the current recovery. Time will tell. That's what I mean by that is this little uptick that you see on the far right-hand side of the graph.
Mark, we're getting a lot of interest from our audience about that Indianapolis presentation. Did you actually get the recording that we can post yet?
Don't have the recording. We did post all the slides on the Manifest forum.
Okay, I'm not certain for the audience, so I don't have to type it 50 times. We're not certain that we're going to get the Dr. Will part of the presentation, but we'll try to, and if we do, then it'll be part of our YouTube channel like all the rest of the things we do.
Yeah, and when we do, my first inclination on something like that would have been to trim it out, but I'm leaving it in based on the number of times that he said stuff which actually fit pretty well with some of the stuff we talked about later on in our presentation too. All right, and this was one of them. We talked about Jim Cramer in his most recent book, at least from about 8 years ago, Get Rich Carefully, where he points out that recessions don't really happen until you have a drop-off in employment. And as Dr. Will pointed out, it is a lagging indicator, but you basically can't claim a recession until you do have a drop-off. So his expectation would be that we will ultimately see a decline in overall employment at some point. And Cramer covers this very well in that book that we did the book report on several years ago. All right, just kind of pressing on. There's the Purchasing Managers Index, and we'll close with Prime Minister Churchill. And he's just pointing out that I think basically investors are optimistic, Ken. And pessimism can cloud our perspective. And as long as you keep a longer-term perspective, looking to come out the other side of whatever challenges we're faced with, you tend to do pretty well. Our message to the Indianapolis crowd was just assertively continue to accumulate excellent companies at attractive prices. I know it sounds repetitive, but if anything, ratchet up your requirements for quality, but keep on accumulating would be the way I would put it. What are your thoughts?
Well, the thought that first comes to mind, Mark, is that optimism doesn't sell newspapers. Optimism doesn't put eyes on the television set for advertisers, and optimism is something that is easy to get used to, whereas pessimism has so many different qualities to it that you can use it to sell papers, you can use it to sell advertising, and you have so many different flavors and so many different reasons why something might go wrong that are all conspiracy based or reasonable based or hope based, that when you put all that together, there's no wonder why a lot of investors today, a lot of especially young investors, tend to be more pessimistic than optimistic. But I think that as you season yourself as an investor, you have to embrace optimism, and you have to embrace the fact, and I think you have a slide coming up that I'm not going to steal, Mark, but you have to embrace the fact that you have so much more upside than you do downside in the stock market.
Yeah, and chiming in on that same type of thinking, I too every once in a while watch CNBC. I know you don't believe that, Ken, but they had a gentleman on earlier that said, yeah, but we've not, a lot of what we're experiencing, we have not had an inflationary environment, and most people don't know how to deal with that. And that's what this slide basically is about. During a period of inflation and interest rate hikes, the stock market's done better than most people think. That's why they say stocks are actually the place to be in an inflationary environment until it gets out of control. And that's what this was back here. One time, got a little bit too far out of control. This isn't the end of the world either, in my view of the planet. But the other thing to take note is this was one of the best periods in the history of better investing for the actual stocks that were selected during that time frame. If you just kept your head to the grindstone, then that sounds kind of painful. If you basically kept at it, you had an opportunity to pick some really cool stocks when everybody else was running for the hills. And this is a great slide to basically demonstrate that. Yeah, a little bit of inflation, maybe even immediate and uncomfortable amount of inflation, is not a time for panic when it comes to our approach to investing anyhow.
Well, doesn't it kind of reinforce the idea that the Fed was promoting 2 or 3 years ago, Mark, that in order to really have a healthy economy, they'd like to have 2% inflation, and that kind of ran counter to what a lot of people thought, and yet when you dug down into the reasoning, it did make a lot of sense.
Oh yeah, I'm all for short-term interest rates around 3% after processing some of my father's estate stuff and, getting a couple dollars on a multi-$100,000 account in interest. That doesn't make any sense to me. So people on fixed income, I think ultimately a little bit of interest is not such a bad thing. All right. For a little break in the action, let's talk groundhog just briefly. Sean continues to lead. We have had some bubbling of some of our participants. Ken was trash talking a little bit about being with Herb recently.
I was 10th at the list 2 days ago. I moved down to 18th now. So.
And I see that Nick DiVirgilio moved up into the top 10, but he advises us that his punch bowl's been taken away today by Micron Technology. It's early, Nick. Try not to get too upset. So Lisa and Susan are pushing towards the top of the list. Richard Allen is a perennial list leader. Butch Lang happens to be out of Minneapolis. That's also a club I'm 90% sure he's affiliated with. Bullish Investors out of Minnesota. Some good, clean fun. I have moved up the list a dramatic number, at least 5 notches. I've got a few notches to go. And,
well, I'm sure that you've gone up 5. Am I even out of the bottom 10?
Yeah, you're above the bottom 10 for sure because I know all those people down there. I'm hanging out with them. But, overall, everything does seem to be going a little bit better in general. Almost a quarter of our participants are beating the market. And believe it or not, Kathy Wood lost ground between last week and today.
Well, I'm going to feel real good when the monkey leaves this list, Mark. He's down to 25 now. So I would like to see that continue to drop. So
that monkey bothers Ken so much, I'm not sure he'll be invited back next year. The dartboard selections can be quite annoying. All right. Let's shift gears back to another person that's got a really nice track record. Believe it or not, that track record, which made him ultimately extremely famous, was done over a 13-year period where he beat the market by 13%. And this is the quote we want to center our thoughts on here today. And it's one that's a little bit tough to get your arms around in some cases. You invest $1,000 in a stock, all you can lose is that $1,000. That is a form of risk management, if you want to think of it that way. But you actually stand to gain $10,000 or even $50,000 over time if you're patient. Now, for many of us, over shorter time frames, those numbers seem almost impossible to believe in. And that's what makes what we're about to look at really pretty cool. Your thoughts on this one, Ken?
Well, I'm going to steal this next slide, Mark, just exactly the way you have it framed, because I think it's one of the best slides that you've ever thought of in the last maybe 10 years. I think it just lays things out so clearly. It's not this one, it's the next one, I think. But it lays things out so clearly that I don't want to spoil it, so let's get to it.
Well, I'm just going to say that what Buffett and Munger say, the hardest thing for any investor to do is to sit on their hands and do nothing. And that's exactly what you have to do to be patient. Be patient for a pullback like what's been happening, and then I kind of, I'm the oddball. I rub my hands together and go, ooh, the candy store's open. What am I going to get? So, yeah, be patient.
All right, so here, this is the setup slide. This is kind of the calamity slide. What you're looking at here are the 20 worst decisions in terms of how far one of our selections dropped from an opening position of $1,000. And the ones that are not highlighted out are active positions. So Ardelyx has 6 of the 20 active positions on here the very top one on the slide, Hugh picked Ardelyx back in May 2015 at a price of $10.91. It's gone down to $92. Keep in mind that he and those of us who follow the company believe that the thesis is still intact. So, Ken, you probably think we're being really stubborn. You might be right. But that $1,000 has dropped down to 84 in that one active position. And I will confess and admit with my hand in the air that we were stubborn with Fossil. And we didn't listen to ourselves. So these 5 positions, we'd have been so much better off if we'd have listened to ourselves. And they did result in a fairly significant loss for the roundtable portfolio. All right. And so these start piling up. You see these and you start feeling pretty gloomy. There's quite a few more of them. They start getting obviously smaller losses as you work your way down the list. I had fun. I had a winning position with Stryker, messed up on this one. I had a really nice winning position in research, but not this position. Just kind of some fascinating companies. And of course, Ken continues to cheer on for Vera Bradley. That came up this weekend in talking about Indiana stocks too.
Go Vera. Okay.
All right. So Ken, take us away.
Well, Mark, this is a slide you put up, and you deserve all the credit for what this thing says, but I think it's so profound. We've made 697 selections in the roundtable. That's over 12 years, making 2 or 3, sometimes even 4 or 5 selections every single month. And that's at $1,000 each. And we've been doing it since, like I said, 12 years, since 2010. 222 of the selections, almost 32%, have current, they're still active, or they have terminal, gulp, we've frozen them, values less than $1,000. And we've lost in these 222 positions $61,000 plus. But the gains from our 5-time selection, that's investing $5,000 in Microsoft, the gains for that one positive stock are enough to wipe out the losses for every one of our losses, whether it's current or whether we've already frozen it. I think it's profound. I think it goes back to this idea of hitting home runs. You just don't need a whole bunch of home runs to balance out a whole lot of strikeouts.
Yeah, because Microsoft has a whole lot of solid company on that winner list. That's how you get to a 16% rate of return over that time frame. Frankly, I was stunned. I was tempted to start this session with everybody taking a guess at how many of the 700 selections were actually negative, and I would have guessed maybe 100. And at 222, I was a little bit stunned by that. But boy, if this doesn't capture, again, that's those $1,000 investments in Microsoft doing that, becoming that, like he says on this cover slide right here, $10,000 each. So it's not science fiction. We've actually watched it. And that's pretty powerful. David Gardner does a nice session on this also at the Motley Fool about how his home runs so dramatically offset the losers that he doesn't even think about the losers.
And excuse me, Mark, and the one lesson that we've taught ourselves over the years, if you go back to when we started selling a lot of those losing positions, especially the big losers, you'll notice that there's a kind of a time gap in there. Could you go back 2 slides, Mark? Nope, just 1 slide. Notice that we didn't really start selling a lot of these in 2010 when it would have been the beginning. The earliest sales, well, we have one down there in 2011, but the earliest sales are going in 2012 and then moving past that. It took us a little bit of time to believe our own rhetoric. and to suggest that when stocks lost a lot of money in a short amount of time, they needed to be moved out of the portfolio, period. Get rid of them. There's no room for that to happen. And so we allowed some of these to go a lot further than we ever should have allowed them to go.
Yeah, it's certainly true for fossil. The other thing that you can notice from this is a lot of the columns on here are, or the rows on here are from those first few years. There are very few entries on here that aren't named Ardelics that have happened in the last few years. So it's also a suggestion that maybe we're getting a little bit better at this stuff too, Ken. Always improving.
A little bit more timid, maybe.
Well, I do know that you made a pledge to stick to higher quality stocks a few years ago, and that has certainly paid off.
Well, except for that one about the Bolo thing, yeah.
Well, that's
been on TV recently, by the way.
Well, sure. That was the night that you and Kim were both indulging in some type of adult substance that we all wished we had.
Maybe it's when that dispensary opened on the corner by my house. I don't know.
We're speaking of the night you chose cricket, Kim.
Oh, I knew.
And it's a night which shall live in infamy at some future round table, I'm sure.
Well, let's just say each one of us is going to have one of those stocks because I think Ken does, and I think you do, Mark. So
Yeah.
Go.
I have multiple injuries when it comes to this topic, so I'm not casting any stones that don't come back and nail me. All right, so let's go to our S curves for the week. These are pretty cool too. This is an important one. As we talk about the projected return on value, not depending on the PE ratio, because stocks that have issues with earnings can be quite disruptive. And this is one that you might want to watch, especially if you are a stock watcher or if you hold Berkshire Hathaway in your investment club. This is what Warren has been warning us about for a couple of years. Their second quarter operating results are dramatically different than their actual reported, SEC reporting results. They're actually going to report a large loss during a period when the business is doing just fine. And so the point to be made, here's a long-term look at Berkshire Hathaway. We'll probably go back and make this a much longer look at some future session. But Berkshire Hathaway, they saw operating earnings actually go up nearly 40% in the last quarter. But they're actually going to show losses because they are required to report unrealized losses when they report their operating results as part of their quarterly earnings. So on your stock selection guides, I suspect you're going to see a big downdraft on the EPS line. It only came out yesterday morning, so it's coming. And the point being, as Buffett has been saying all along, don't look at earnings to judge how my company's doing. Pick something else. That's book value up at the top, by the way. Your thoughts, Ken?
I agree, Mark, that when you start having to discount some of the other things that make up some of these large conglomerates, you muddy the waters to the point where it's very difficult to track through and find out what the actual business is doing. Berkshire has as much money as a typical regional bank does, probably.
Absolutely. All right, so that's our first one. The other one we wanted to clear up a little bit last month, and I actually made a mistake last week. I had not made all the changes that I should have as we displayed Tin Cup. This is a current Tin Cup model portfolio. Again, this is the qualified plan at work 401k type emulation going back to the mid-1990s. It's up to 3.65 million. And I had displayed that we had Axos Financial in there, and we don't. Actually gave it a timeout. And we have replaced it with the positions that are shown here we actually added Generac recently and installed building products this month. So this is the current portfolio. That led to a number of questions about Axos. our situation, the situation at Axos that Ken and I were referring to is, again, probably a blip in the long-term picture of the company. But it really does relate more to our concerns over some fairly hostile press that they were getting a few months ago. It was fairly widespread. It doesn't even have to be factual. It does enough damage whether it's factual or not. And the other point to make on this particular slide is just an awareness of when they do hit a speed bump, a company like this can have a pretty large downdraft in their stock price. So we're aware of that for a company like this, and it becomes a part of our decision making. Anything you want to add to that, Ken?
No, except for the fact that the other thing that went through my mind is that Axos is the successor company of a company that used to be called Internet Bank Corp, I think was the name of it.
It was actually Bank of the Internet.
Bank of the Internet. Thank you, Mark. And back in 2006, 2007, my investment club put money, took a nice position in Bank of the Internet because they were really growing hand over fist and things were going correct for them. It was one of the first banks that was loaning money to future home buyers and loaning it to them on the basis of a pay stub. They weren't doing any real research. They weren't requiring 20% down. They were breaking the mold on what you needed to get into buying a typical house. And we talked about it and somehow convinced ourselves back in 2007, this is my primary investment club, we convinced ourselves that that was a good thing. Now in 2008, we convinced ourselves that we were fools and we sold the stock, but that's after it had lost a significant amount of money after the housing crisis and the market and the Lehman Brothers fiasco and everything else happened. But this Axos is the successor company. And when you started hearing rumors about them doing some things that might be a little bit shady, and then you started hearing everybody piling on with stories about what was going on, it made me, deja vu, feel a little bit ill in the stomach. And I just wanted out of the stock at that particular time, whether there was actually any provable offense or not. So that's where we were coming from with Axos. This might turn out to be a perfectly wonderful investment, Mark.
Absolutely, and we would continue to look at it that way. From the perspective of Feraldi's thought about the life cycle of companies, there is a kind of a flat spot there. I think you can see an inflection point in the growth rate somewhere in this time frame. So you're looking basically at a second stage company on the left-hand side, probably an early third stage on the right-hand side. You can definitely see that the trend for revenues here in the last few years is at a slightly lower rate. It is dropped down to somewhere between 11 and 15, according to Value Line. But this was the other thing that came into the thing as we talked about it here with the best small companies portfolio. Again, we only have between now and Halloween for this particular portfolio. And Axos, as part of the portfolio, had actually been lagging the general financial sector. You see that here, where it was running together up here, and it actually dropped more. So that was a part of the opinion that Ken and I formed back at that time frame. Again, when you're talking about dealing with a bank or a regional bank, you have a whole lot of places to go for options. If you're short on banking options, just send Ken a note. He'll send you back 42 tickers that you can study. There are plenty of alternatives.
Don't send me a note, please.
Okay, we'll present them here. By the way, we presented like 800 a few months ago. If you want to go back and look. So in this case, they were lagging their own sector back in that time frame. And again, we only have between now and Halloween. They've actually lagged them on the recovery. So good long term, these guys might be fine. One of the reasons we just kind of took a time out and stepped back. All right, here's Neogen, the company we're talking about possibly being involved with a merger. They are having a partial merger or acquisition that is in progress. We'll probably add a few years to this chart at some point in the future also. But again, just pointing out that somewhere in this time frame, they go through a phase of probably a little bit of a downshift in growth. I think that the growth rate here is a little bit less than that on the left. So these guys are probably either in or approaching the maturity stage of their life cycle or in the early phases of it. You can see a little bit of a plateauing of earnings down here, just to be aware of. A plateau in earnings can be the sign of we almost think of it as a downshift. And also, this is a company that can be quite volatile when it comes to any type of a speed bump, just because of the nature of the company, although it's been extremely good to a number of local shareholders, including many of our community members. Any other thoughts?
I guess, yeah, I want to be kind of honest about Neogen as well. I still do own a stake in Neogen in one of the IRAs that I manage for my wife. But our thesis about Neogen was that after 2009 and after the recovery, and you can see that the price moved up pretty nicely up into 2018, 19, that period of time. We really thought that one of the big guys would come in and acquire Neogen. We really expected that to happen. And in fact, it didn't. And you see that Neogen has kind of plateaued now rather than continuing growth. I think that's the reason that Neogen went looking for something large to acquire to give it some more growth. I think it had exhausted a lot of the avenues of growth. It had turned the niches that it had occupied into as much profit as it could. It wasn't losing money from those niches, but it certainly wasn't growing at any fast rate. I mean, how fast can you grow rodenticides and things for cow udders and things like that? So I really think that that precipitated the need for the new acquisition, which is going to be quite large compared to the company. And I hold out hope that it's going to begin to continue its earnings and sales growth now at rates where it might have been in the teens. And I'm keeping it in the portfolio at the moment.
Yeah, and that robust period that Ken was just describing is shown right here also in the PE ratio. This goes all the way back to the year 2000. The PE ratio, look at the PE ratio. It's in the 50s all through this period. Do I think it's going to stay in the 50s forever? No. Do I know when it will return to 30? No. But I do point people to Paychex as an example of a company that lived in the 40s and 50s for decades, and then has ultimately settled back into the 30 range for PE ratio. So as you're doing your study of this company, it's just natural. Some of the flat spot in the stock price is due to what you're looking at right here, and that's just a maturing. They're gonna come back somewhere in this range in the future.
And Mark, I couldn't honestly look at a PE of 47.84 and say buy either.
No,
I still think that PE ratio is significantly higher. And I think it's based on the fact that this company has been so consistent and so reliable over such a long time that people still hold out a lot of hope to it, maybe too much hope.
Yeah, and during a period of significant promise and growth, I mean, I like to look at this for anybody out there in the audience. I know there probably aren't any, but just in case somebody's listening on YouTube in the future, this is an average PE of 32.5. That's an average PE of 32.5. You can tell by looking at it because it's from 50 to 25. And for those that don't like to go above 20 or 30 for their average PE, just give that some thought. It does happen when it's deserved. All right, Intuitive Surgical, another company that we can talk about for just a minute. This is another Len Douglas favorite. The point of this one is just to illustrate different phases. This is obviously a situation where the company was trucking along at least that first or second level of the life stage of company, and you can actually see the downshift moment. Here it is here it is in the stock price, and sure enough, they came out of that with a more mature, still a robust growth rate for a nice company like this, but a company that had been growing at closer to 20% per year did a little downshift and basically entered the maturity phase of their life cycle, and are now looking at 10 to 13% instead of what had previously been closer to 20%. Completely natural stuff, but something to watch for is this moment in time, looking at the longer term picture of a company's life cycle.
Well, and we should remind people, Mark, that expectations for large companies are usually only around 6, 7, 8%. So that 10% expectation on growth is still great growth for a company the size of this one.
Absolutely. All right, we'll close with Stryker. This company is definitely in the Hershey stage of its life, that maturity cycle, just kind of cranking along at something approximately 8 to 10% on the top line, and with a pretty nice picture overall, stock price wise. And from an earnings perspective, you can see this is that thing we've talked about, elective procedures being down after the Affordable Care Act, and then here, of course, is COVID. But other than that, those two little speed bumps, this one's been a pretty good company for a lot of us.
Stryker does a really nice job in its annual reports, Mark, breaking down the major components where they make money. You know that they make money in a lot of things other than hips and knees. They have a hospital equipment, and they have a number of devices that they make money in. It's interesting to look back in the last 5 or 6 years at their annual reports and compare the graphs and notice how the product mix has shifted to products of higher margin. And I think that accounts for the fact that management decided somewhere in the mid-20 teens that they were going to have to change their business model slightly, or they were going to move into that phase of, what do we call that last phase on the graph there? Maturity, is that what it's called? No, one past that.
We'll go back and look just so you can point it out.
Oh, decline, yeah. And if you look at that graph there in 2013-14, Stryker actually was beginning to move in the wrong direction. And then you, like I said, from their website, you can get their annual reports, and this graph is in the annual reports. You can look at it over time. It'll take a little bit of fiddling around to pull each one of them up and take a look at it. But if you're interested, you can see the concerted effort to change product mix, and you can see what it does. Then it kind of reinvents the company, recharges it, and moves it well back into that mature stage where there is growth going on again. It's not declining, and it's a fascinating kind of a thing to watch. We've always said how much we admire the management at Stryker, and that's just one more reason to admire what they've been able to do.
Yeah, and here's a current look at some of those characteristics Ken was just talking about. You can see that the operating margin did relax back a little bit here on the right side, and everything that they can do to restore it. They're trying to keep the bottom line profitability on a decent trajectory. If they're successful in doing that, that'll enable that PE ratio to stay in the 20 to 30 range, mid-20s as a minimum. But again, solid company, been good to us, and the projected return on value does match up pretty well with this number here. That does suggest that this PE ratio might be just a little bit ambitious when this one's at 12 and this one's at 8. But again, that's all under the perimeter of a single nickel laying on top of it. So don't get too carried away there. And look at their debt. They paid less than 2% on their mortgage, trading fairly close to their 52-week low. Morningstar thinks they're a pretty good deal, fairly valued, I should say. And Value Line, again, I would call that basically fairly valued too. So fairly valued and making a lot of good calls. All right. Let's close with a couple quick comments from our Indianapolis weekend. One of the things we did and had some fun with is I searched our database for all Indiana-based companies, and we attempted to build a portfolio of 16 companies that we will now compete with the S&P 500. You can see that we divided it up equally, and we will be comparing these two numbers over time. Of course, we'll give it a little bit of run time. This only has a couple days in it right now. But you find some pretty interesting companies. By the way, Vera's number 2 on the list already, Ken.
I know she's a fast starter, Mark. Okay. But it's not too often we build a portfolio with a stock of a quality of 5 in it. So
it's
buyer beware. Buyer beware.
It's in there because we are cheering for the turnaround. You know, they have a restaurant now, and they serve food, and they actually have a hotel you can stay at there. I know this because my family has done it.
But it's out in the middle of nowhere.
Not me, but the ladies in our family have done it. So
it just sits in the middle of a cornfield, Mark. There's nothing around it. Nothing.
Yeah, but we ladies like our purses and bags.
You're right. So there's actually some really cool companies, a little low on the growth side in Indiana, but there's no tech sector companies, but I think they're going to do all right. And that leads perfectly into this one. Why do I feel that way? I'd never done anything like this. I took the companies that are on that list, put them in that same metric that we've been sharing. Keep in mind that the expectation for 2022 is down closer to 4% for the entire country, down in here, in other words. Okay. And the expectations for those Indiana companies is actually pretty good, pretty solid. And I think it's a perfect example of how, depending on where you're at in the country, you hear about geographic recessions and geographic bear markets and sector bear markets and all that kind of stuff. By the way, this is the part of the country that includes Elkhart, Indiana, and recreational vehicles. And it's looking like this. And
well, Indiana has a lot of steel mills because AK Steel is there. And I saw on your list you had STLD, another steel company.
Yep, and there's another one that escapes me off the top of my head that's there also. Well, Nucor has many facilities in the state.
Yeah.
But I mean, you know, you look at this, and this basically says that, again, it's a perfect demonstration of how recessions and corrections, et cetera, bear markets can be a local phenomenon also. And just having a little bit of fun with that. We might do some more tinkering with things like that. Final thoughts, Ken?
Well, maybe we'll have one of these for Michigan by the time that Mid-Michigan does its stock pickers breakfast in November. If you're anywhere near Saginaw, Michigan on the second Saturday in November, you're invited to our breakfast. We have quite a time, and we have quite a raucous group that wants to pepper us with questions, and they leave there with lots of ideas. We'd love to have you if you're anywhere near.
Duly noted. You can count on it. All right, here's our best small company update. It's been quite an active week. iRobot it was announced that iRobot is being acquired by Amazon, and that actually ticked the price up a little bit. I think Amazon's getting it a little bit cheap. Well, I'd like to see that price go up a little bit higher. But these are all behaving better as a group. You can see that we are narrowing the gap between our buy and hold portfolio and our managed portfolio versus the Wilshire 5000. The other thing that I would point out is that the Russell 2000 Growth ETF, Exchange Traded Fund, is within an inch of coming out of its bear market once it gets above 1600. So many of these are doing pretty well. Ken, I think we noted that Boston Beer actually is bubbling up towards $400 a share.
Yeah, that was down in the negative high 20s at one point in relative return, and it's come back to negative 10.6 now, so that's pretty good. I wanted to remark on those graphs at the very top of the page to look at the scale when you read the bar graphs. It looks like the green bar is quite a ways ahead of the blue bar and the red bar. but in reality, we're talking about a gap there of maybe $1,100-$1,200 between the red and the green, and way less than that between the blue and the green.
Yeah, they're within $100, so we've got time between now and Halloween. We remain hopeful as long as I don't get to pick another stock. All right. Here's a reminder that we have all of these on YouTube. Everybody here knows this. Please subscribe to be notified when we make or add content to the page. Plus, it's going to help us once we get to 1,000 to actually have some interesting things that we can do working with YouTube and Google and all that kind of stuff. Can't wait to have that opportunity. So if you have friends and family, have them sign up, whether they use it or not, to run our numbers up. We do put all the bull sessions and the roundtables on here so you can go back and check them out. So with that, I'm going to actually be at Burt Lake next week. That's an actual picture that we used for our COVID cancellation series, you may recall. That was actually a cover slide. And the subtext is pretty obvious. That's what I will be doing with 3 grandsons. It's a great week. I don't know. I haven't decided yet, Ken. You'll have to twist my arm and tell me to take vacation, whether or not we'll check in with something.
Take vacation.
The other thing that I thought I might do is slap together a best of to actually put on YouTube, but we'll see. I have not decided yet what I'm doing for sure.
Vacation's fine with me, Mark.
Okay. Okay. So our next roundtable, live roundtable, will be in 2 weeks. Excuse me. Our next live bull sessions will be in 2 weeks.
Sounds good to me. Sounds excellent. I know that I have somebody sitting in the other room that's going to be applauding that decision. So
Okay. Yeah, she encourages me to take some time off every once in a while too, so I appreciate that. All right, I'm going to go ahead and shut down the recording.